Welcome to Read in Minutes. Here's a short summary of the book, The Big Short, Inside the Doomsday Machine by Michael Lewis. If you enjoy it, please hit the like button and don't forget to subscribe to our channel. Now let's get started. The Big Short, Inside the Doomsday Machine by Michael Lewis delves into the intricate and often baffling world of finance to uncover the root causes of the 2008 financial crisis. The book offers a fascinating look at the personalities and mechanisms behind the collapse, focusing on a handful of outsiders who bet against the booming housing market and won. In the early 2000s, the United States housing market was on a seemingly unstoppable rise. Home prices were skyrocketing, and everyone, from homeowners to Wall Street bankers, seemed to be reaping the benefits. The banks and financial institutions played a critical role in this boom. They were granting home loans to virtually anyone who applied, including people with poor credit histories. These subprime mortgages were then bundled together into complex financial products known as mortgage-backed securities, MBS, and sold to investors around the world. The idea behind these securities was simple. Even if some borrowers defaulted on their loans, the overall investment would still be safe because the risk was spread across many loans. This assumption proved to be disastrously wrong. The core problem was that many of these subprime mortgages were essentially ticking time bombs. Banks were not properly assessing whether borrowers could repay their loans, leading to a massive increase in risky loans. Financial institutions were motivated by short-term profits from fees associated with originating and selling these loans, rather than the long-term health of their investments. The narrative of The Big Short centers around several key figures who recognized the impending disaster and decided to take action. 1. Michael Burry, a former neurologist who ran the hedge fund Scion Capital. Burry was one of the first to spot the weaknesses in the subprime mortgage market. He meticulously analyzed mortgage data and concluded that many of the loans were likely to default. Burry decided to bet against these mortgages by purchasing credit default swaps, CDS, a financial instrument that would pay out if the mortgages defaulted. 2. Steve Eisman, a hedge fund manager at Front Point Partners, known for his blunt and outspoken nature. Eisman had a keen eye for spotting fraud and malfeasance in the financial industry. He was appalled by the recklessness he saw in the mortgage market and decided to bet against it by buying CDS on subprime mortgage bonds. 3. Greg Lippmann, a trader at Deutsche Bank who realized the potential profits to be made from the impending collapse of the housing market. Lippmann became an evangelist for the short position, convincing other investors to buy CDS on subprime mortgage bonds. 4. Charlie Ledley and Jamie Mai, founders of the small hedge fund Cornwall Capital. These two young investors stumbled upon the opportunity to bet against the housing market. Despite their lack of experience in Wall Street's inner circles, they recognized the massive risk in the subprime mortgage bonds and decided to take a chance by purchasing CDS. These investors used credit default swaps to place their bets against the subprime mortgage bonds. A credit default swap functions like an insurance policy on a bond. The buyer of the CDS pays a premium, and if the bond defaults, the buyer gets paid. By buying CDS on subprime mortgage bonds, these investors were essentially wagering that the housing market would collapse. As the housing market began to show signs of trouble, the value of subprime mortgage bonds started to decline. However, the financial industry largely turned a blind eye to the growing problem. Ratings agencies, tasked with assessing the risk of these bonds, continued to give them high ratings, falsely reassuring investors of their safety. Banks and financial institutions were making enormous profits from these bonds and were reluctant to admit any issues. The bubble began to burst as default rates on subprime mortgages soared. The financial products built on these shaky foundations started to unravel. Major financial institutions that had heavily invested in these mortgage-backed securities faced massive losses. The collapse of Lehman Brothers in September 2008 marked a pivotal moment, triggering a chain reaction that spread throughout the global financial system. The investors who had the foresight to bet against the subprime mortgage market reaped substantial profits as the market collapsed. Michael Burry, Steve Eisman, Greg Lippmann, and others saw their predictions come true, and their investments paid off handsomely. However, their success came at a significant cost to the global economy. The financial crisis led to millions of people losing their homes, jobs, and life savings. The ripple effects of the crisis were felt worldwide, leading to a deep recession and prolonged economic hardship. The Big Short underscores several critical lessons about the financial system. 1. Greed and recklessness. The financial crisis was fueled by a culture of greed and reckless behavior. Banks and financial institutions prioritized short-term profits over long-term stability, engaging in risky lending practices and creating complex financial products without fully understanding the risks involved. 2. Regulatory failures. Regulatory bodies and ratings agencies failed to provide adequate oversight. They missed the warning signs and allowed dangerous practices to proliferate. This lack of proper regulation and accountability contributed significantly to the crisis. 3. Complexity and lack of transparency. The financial products at the heart of the crisis were highly complex and opaque. This complexity made it difficult for even seasoned investors to fully understand the risks, leading to widespread misunderstanding and mismanagement of these products. 4. Moral hazard. Many of the individuals and institutions involved in the crisis were not held accountable for their actions. This lack of consequences created a moral hazard, where risky and unethical behavior was rewarded rather than punished, setting a dangerous precedent for future financial practices. In conclusion, The Big Short provides a vivid and compelling account of the events leading up to the 2008 financial crisis. Through the stories of the few individuals who saw the disaster coming and decided to bet against it, Michael Lewis exposes the systemic flaws and failures within the financial industry. The book serves as a stark warning about the dangers of unchecked greed, the importance of regulatory oversight, and the need for greater transparency in the financial markets. It is a cautionary tale that highlights the devastating consequences of a financial system driven by short-term profit at the expense of long-term stability.